stock market makes absolutely no sense right now. It swings wildly. It hits new all-time highs while the economy feels shaky and valuations are still extreme. Everyone's either petrified or totally hyped. In this video, I'm going to show you what to do right now, not tomorrow, not after the headlines change, right now, so you're not left guessing or getting burned. Stick with me. I'm going to help you turn chaos into opportunity. Now look, whether you're new to investing or you've been at it for a while, this market probably feels confusing. One day we get massive volatility, we get sell-offs, we have fear in the economy. The next day we're rebounding, all the media is pumping the news. We're going to have all-time highs, everything is going great. Job reports continually conflict, and so does the inflation data. The consumer looks and feels fragile. Rate cuts are hyped up while uncertainty grows on what the Fed will do. And the AI hype is everywhere while the bubble, I consider it to be a bubble, continues to grow. Investors are torn between fear and FOMO, which is the fear of missing out. Now, I'm not going to share some complicated Wall Street jargon in this video. That never works for anybody. The second you hear that, avoid that person. Instead, my goal is to use plain language that any investor can understand. So we're going to talk about how the market can keep rising even when the economy looks shaky, why valuations matter more than ever, and what I personally do in times like this. Then we're going to shift into opportunity. The Stockstore community is watching the way I evaluate quality and uncertainty, and even how my own option strategy can help me not just survive, but in the long run, crush the market. By the end of this video, you're going to know what to avoid, what to focus on, and how to take action in a world where the market looks insane, but opportunity still exists. So let's talk about the most important part about money. Let's talk about the emotions. Because most of what holds investors back isn't numbers. It's fear. It's FOMO. It's the stomach. It's the emotions. One day, the market drops and the headlines scream market crash. Then a few days later, the same market is near all-time highs and everyone's saying you're missing out if you are not buying. The whipsaw of emotion, fear then greed, is why most beginners make big mistakes. I've been there. I've done it. Everyone has, including Warren Buffett. Most people think one or all of these three things. I should sell because the economy looks bad. I should buy because the market keeps going up. Or I should wait until I know what's going to happen. Guys, all three of those statements are the wrong things to think about. But the truth you need to know is that reacting emotionally almost always leads to the wrong decision. So let's slow down and actually understand what's happening when we're looking at these headlines and the markets. Here's something that all new investors don't understand. The stock market doesn't always reflect the current economy. It reflects the investor's expectation of what the economy is going to do in the near future. So think about it like this. If you expect a company to make more money in the future, you might pay more for the stock today, even if sales are slowing right now. It's the same with the whole market. Right now, the economy shows mixed signals. Consumer spending is softening in several places. Inflation isn't falling as fast as expected. Jobs data shows jobs added one day and unemployment rising the next day. And the rate cut forecast from the Fed changes every week. Yet the stock market keeps on rising. How does that make sense? It only makes sense if people are betting on the future, on earnings growth, on innovation, on some idea that things will get better in the long term. But if those expectations don't play out, the market reprices, and that's when we see big drops. But I want to make note of something. That big drop happens before the expectation has occurred. It drops or goes up based on people's feelings about it. This disconnect is super important, and it's why you can't just look at the stock chart and assume everything is fine. Let's talk about something that should really get your attention. And what's funny is no one pays attention to it, and yet I think it's the most important metric. And that is how overvalued the stock market is. Guys, we see a price going up, and we think, okay, that's a lot of money, that's overvalued. The price going up doesn't make it overvalued. It's what you're buying. Here's my example, and this is gonna be extreme. Let's say your neighbor has a Ferrari, has an Enzo Ferrari. This is a multi-million-dollar car. And one day they say to you, hey, I need money. Will you pay me $500,000 for this? And you say, let me think about it. The very next day, the person goes, you know what? I had an offer for $750. You want to pay $800. The price just went up 60% on you. Does that make it overpriced? No, it's still a multi-million-dollar car. It is still a good value, even though the price has gone up. The same thing goes on the flip side. Just because something is cheaper doesn't make it cheap. If that same Ferrari Enzo, let's say it's worth $5 million, somebody's asking $100 million for it. You're like, no chance. They come to you the next day and say, you know what? I'll take $50 million for it. It's still overpriced. Do not follow the price. Follow what the price is buying you. And one of my favorite indicators is called the Buffett indicator. This is a major indicator for stock market valuation. It compares the entire size of the stock market to the entire US economy or the US GDP. And it makes sense. As US GDP gets bigger and bigger, the companies within it will also get bigger. And right now, that ratio is massively out of line. Let me show you the numbers. I do this on the S&P, not the entire stock market, but it's still a ratio. Guys, we are currently 128% overvalued. Now, the more you pay for something, the less your return's going to be, right? Makes sense. That same Ferrari Enzo, it's $5 million. If you pay $10 million for it, you lose a lot of money. If you pay $1 million for it, you make a lot of money. Makes sense. Well, let's go look at the history going back 100 years. The more undervalued the market is, the higher the next 10-year returns. And by the way, these returns are not including dividends. The 100-year average is 6.4% per year over any 10-year period. When it's 30% or more undervalued, the average return is 10.7. As you get more and more overvalued, what happens to the returns? 9%, 2%, -1, -2, -2.4, and that's at 50% or more overvalued. Again, does not include dividends, but guys, we're at 128% overvalued. This is massively overvalued. Massively. Buffett himself once said that when this ratio is way above average, it's one of the strongest signs of overvaluation in the market. But it's a little confusing. Why? Because look at these numbers. It's been overvalued for a long time. And guess what? We see the stock market continue to go up. So of course, naturally, what are people going to say? Well, that metric doesn't matter anymore. And I get that. It doesn't matter in the short run, but in the long run, you better fucking believe it matters. You can't trust stock prices to tell you the truth. They don't care what you paid for a company. A stock might be up 30% this year, but that doesn't mean it's worth 30% more. That's why I always say price versus value. Price is what you pay, value is what you get. Our goal as investors is to buy when price is below value. If you're paying right here, I don't know the future, but in all likelihood, based on history, this is going to be a problem for purchasing stock and getting returns for the next 10 years. You've got to know what a company is truly worth, not just what the market says its price is today. So yes, the market is massively expensive based on history, but that doesn't mean you stop investing. And this is something that I hear all the time. Well, if the stock market's overvalued, why would I invest? I get it, but there are solutions to this problem. You need to invest smarter with more analysis, more patience, and more disciplined. A stock price is just what people are willing to pay today. Value is what the business is actually worth based on the profit, the growth potential, cash flow, balance sheet, all of these things. The real stuff. Here's the key. And it's our fifth tenet of principle-driven investing. And it's something that everybody and everything money will all live by. A great story becomes a bad investment if you pay the wrong price. And right now, a lot of stocks and the stock market are trading at prices that assume above perfection in the future. The best earnings, the best growth, the best everything. That's overvaluation. Now, overvalue doesn't mean a stock's about to crash tomorrow. It means the price has got ahead of real business fundamentals. And if the company doesn't actually deliver those perfect results, the stock price will adjust. And yes, most times violently. That's why focusing on price versus value isn't some boring academic thing. It's what protects your money in uncertain markets. Now, guys, I mentioned earlier the principle-driven investing. There are 5 tenets that our community and myself live by. I have this thing in front of my camera, at my desk, at my home. Here are the 5 tenets. First off, we are investors, not speculators. Second, every investment is the present value of all future cash flow. Third, if we don't understand it, we don't invest in it. Fourth, in the short run, the stock market's a voting machine. In the long run, it's a weighing machine. And the fifth one that I mentioned before, and I need to repeat it over and over again because it's probably the most important one. A great story becomes a bad investment if you pay the wrong price. These 5 tenets act like a guardrail that keeps me from making the most costly mistakes that destroy most people's portfolios. When I remind myself we're investors, not speculators, it stops me from chasing the hype, the hot stocks, or trying to time the market based on emotion or hype. Focusing on the present value of future cash flows forces me to actually look at the numbers, instead of just getting caught up in some price going up and down. The rule about only investing what I understand has saved me countless times from putting money into complex businesses or trendy sectors that I can't properly evaluate. Guys, I need to understand, what's this company going to grow in the future? What's it going to profit on that growth? If I can't understand that reasonably, of course we don't know the future, but if I'm just purely guessing, then I got to stay out of it. Remember, in the short run, stocks are a voting machine. In the long run, they're a weighing machine. In short run, what's popular is going to go up, what's not popular is going to go down. But in the long run, the fundamentals of the business are going to drive the price. If I pay a reasonable price for a business today, and 20 years from now, the profit is 10 times greater, then the stock is probably going to be 10 times greater as well. This helps me ignore the daily price swings and focus on the fundamentals of the business. So many times we'll see a stock price falling, but the fundamentals getting better. That should be an indication to pay attention. And the final principle, great stories become bad investments if you pay the wrong price, is the most important one, because it stops me from overpaying for even fantastic companies just because I love the story. There's a lot of great stories out there. There's a lot of great potential. But would you pay $100 trillion for them? No, of course not. Well, that's my point. You'd pay $1, you'd never pay $100 trillion. Somewhere in that middle, it goes from making sense to not making sense, being a good investment to being a bad investment. Together, these principles, these tenets, force me to think logically rather than emotionally. They focus on facts rather than feelings and make decisions based on value rather than momentum, which is exactly how you avoid the expensive mistakes that turns investing into gambling and speculation. So guys, if you want those tenets, if you want them sitting there at your side so you can become the investor you've always wanted to be, which is calm, collected, and when everybody else is screaming for the hills, you're grounded, click the link below. I will email you this principle-driven investing PDF so it's readily available for you like it is for me at all times. Now, let me show you the kind of stocks our community looks to buy in uncertain times. Guys, in our software in our community, we have this right under stocks. So if you're part of our community, and you have our membership, it's right here under stocks at community stock rankings. Guys, we have top holdings, top searches, and top rated. So there's a couple of smaller companies and some big ones, but I look at these and think to myself, okay, let's take a look at a couple. Adobe. Adobe is rated a buy with 179 ratings on it. That's a lot. Let's pull up this company and let's see top searches, by the way. Look at all the top searches from our users. Oh, it's great, guys. I love it. And the top holdings right here. Oh, NVIDIA is actually a top holding, 235 holders. So you're telling there's a lot of people who believe different things than I believe here. PayPal, Meta, Google, Alibaba, Amazon. Oh, these are great holdings. All right, so let's go to top rated. I'm going to pull up Adobe here. So Adobe is a company that hit an all-time high of $700 back in 2021. $700 4 years ago. It is now at $350. It's half the price. And I guarantee you that if we made a video on Adobe, which I don't know if we did back in 2021, I guarantee you people would have said, there's no way Adobe, it's a great company. It's not going to fall in half 4 years from now. It's going to keep going up. I hear it every freaking time. And guess what? Sometimes it never goes down. Okay. I don't really mean never goes down, but I mean in terms of like falling 50% in a matter of 4 years. But guys, this company is down to $357 a share. The average rating is a buy with an intrinsic value of $486. This is an incredible company. $150 billion market cap, $160 billion enterprise value, essentially $9 billion in debt. And guys, guess what? They generated $10 billion in free cash flow last year. And something I love about this company versus others, their free cash flow numbers are higher than net income. Everybody's focused on this, and you're going to realize that the real lifeblood of the business is their free cash flow, which is higher than their net income. Look at these returns on capital. Guys, this is an important metric. This tells you how efficient the company is at allocating its capital. Do they invest in smart projects? When they do invest, what kind of return they get? Are they a capital-intensive business? As they keep growing and generating more profit on the money invested in the business, it just means they don't have to spend a lot of money to grow that. That's incredible here. This is a really high number. Gross margin, 90%. Every extra unit they sell, 90 cents of that. 90% of that goes to the bottom line. That's incredible before overhead and taxes. Growth rate, 10% a year for the last 3, 13% for the last 5, 17.5% for the last 10. So why is the stock down so much? AI. People think that Adobe is going to be wiped out because of AI. All right, AI has been around for what, 2 years now? Let's go see how their quarterly revenue is done for the last 2 years. Well, back in August of 20, so right here, this last quarter, August, they did 6 billion. Let's go back to August of 2023, 4.9 billion. In this part right here was the heyday of AI and growth. They've increased their revenue by 20%. All right. From last year, 5.4 billion, increased by over 10%. Okay. So consistently 10% per year. Again, doesn't mean that's the future, but I believe people are misunderstanding Adobe. I think Adobe will do better because of AI. They won't do worse. They're still the leader in all of this documentation, the Photoshop, all these things that happen. It's really important. Now, guys, I want to remind everybody watching this, if you're new to this and it feels overwhelming, it's overwhelming for everybody at some point. The question is, do you want to be a better investor or not? Do you want to be a calmer investor or not? Do you want to up your investing game? If so, stick with it. It will feel overwhelming, but you do something that probably not a lot of people do very well. Did it happen immediately? Of course not. You had to put the work in. This is why I teach on YouTube, because I started to watch these YouTube people thinking these guys don't get it. They bought some stock, it went up, and all of a sudden they were a guru. They were morons. I wanted to teach on this to show people it's about the numbers. It's about the emotion, putting those things together. A great story is a bad investment if you pay the wrong price. That's not the way the rest of YouTube talks, and that's why I'm here to do this. And if that makes sense to you, which I'm sure it does, stick with us. So, 8 pillars. Oh, so close to an 8-pillar thriller, but it's that PE. Why? Because their net income is lower than their free cash flow, so I'm not worried about that. They're buying back shares. They're cheap shares, which is great. High returns on capital, cash flow growth, net income growth. And what I love is cash flow growth, 4.7 billion in the last 5 years, 3.1 billion in net income. So faster free cash flow growth. Great stuff. Let's see what analysts think. Earnings per share from $21 a share going to 34 in the next 5 years. All right. Pretty solid. Revenue growth, high single digits. 24 billion growing to 36 billion, 50% growth in the next 5 years. I'm actually surprised the earnings per share growth isn't higher. Finally, stock analyzer tool. This is where we put the numbers and the story together. This is where you should start with all your investing ideas. Sit there and see, is it worth your time anymore? If it's not worth your time, don't be discouraged. It could still be a great company that you're just waiting for the right price. But this is where I always go to say, okay, let me put some reasonable assumptions in. Is it worth me digging deeper? So the last time I did Adobe, I did a 10-year analysis. You can do up to 20. I did 4, 7, and 10% revenue growth. Profit margin I'm ignoring because it's free cash flow that matters here, 38, 40, and 42%. I did PE 10 years from now. What's the price to earnings ratio or price to free cash flow that I expect 10 years from now? Guys, this is a premium business with growing returns on capital, high margin, and growth potential. You start at 15 or 16 for regular market numbers. That's the normal average. You go higher for good companies, lower for bad companies. I classify Adobe, in my opinion, as a good company. I did 18, 21, and 24. Now, if you have Adobe and you put 20, 23, and 26, I get it. We don't know the right answer to this, but it's all about putting these together to see where it falls. And finally, no margin of safety, 9% intrinsic value return. If this were to match the market, what would it be worth today? I hit the analyze button. Now, guys, we're not done here after I hit the analyze button here. There's something very, very important that I want you to understand on how I can buy Adobe and be paid to buy it at a lower price. So we'll just wait for that. So the stock's currently at 357. Guys, I have a low price of 380, high price of 820, middle price of 560. If my middle assumptions occur in Adobe over the next 10 years, I'm going to make about a 15% return, discounted cash flow IRR based on today's price. Now, I want to shift gears into something really powerful. Cash secured puts. They're options. Now, I know options sound scary, and I'm glad you think they're scary, but I want to just shift that just a little bit. If you use them the right way, they can protect your portfolio, they can enhance the returns on your cash, and for covered calls, they can add to your returns on your stocks. Options are a contract. It's a way of giving somebody the option whether they buy, sell, whether you buy or sell a stock in the future. It can be used to generate income. So right now, for example, I have cash in my account. And I have a 90-day treasury, so I'm making 3.5 to 4% return at any given time. I can use my cash to buy Adobe at lower prices and get a much higher return on my cash than 3 or 4%. This is one of the most important strategies I use and I teach. That's called cash secured puts. Now, for covered calls, the other thing I teach, you own shares, you have shares. You give somebody the right to buy them from you at a higher price. So you're basically, in essence, renting it out. They pay you, and if it hits that certain price, you got to sell it to them at the much higher price. That's extra income in your pocket. Now, there's no such thing as a free lunch. I think the cash secured puts is a wonderful way of generating extra cash on your cash, as well as buying a stock you love at a lower price. Let me show you guys what I'm talking about here, because remember, the way I'm using options here isn't about gambling. It's about a strategy to increase your returns. So let's say, I'm going to pick a date in the future. Let's say January 23rd, and I want to buy Adobe it's currently at $357. Well, I want to buy it at $340. Somebody's going to pay me $3.67 per share. No matter what, I get that money even if they get the shares or doesn't get the shares. And a month from now, if the stock is below $340, I get to buy the stock at $340. But I also got $370 along the way. So I essentially bought it for $336. And if the stock stays above $340, I don't get to buy the shares, obviously at $340, but I still keep my $367, and I made an annualized return of 12.3% on my cash. So think about that for a second. I know that's a lot right there. And trust me when I say, when I first heard it, I was like, wait a second. But the bottom line is this. I got paid to potentially buy Adobe at a lower price. And if I didn't get it at a lower price, I got a nice return on my cash sitting in my account. What could be better? It's a great way of generating income on cash in your account, as long as you're disciplined enough to know what a stock is worth to you. And just so you know, I am teaching a full options class early next year. We're going to cover what options really are, how to use them safely, how to generate income, and how to protect downside risk. This isn't rocket science. Clear, step-by-step guidance. So if you want to level up your investing game, this class may be exactly what you need. The seats are limited. We've already done one class before. And guys, I believe something like 45% of the people got their money back before the class was over just by starting to write covered calls and cash secured puts. Click the link in the description below to grab your seat. Now, I showed you what puts look like and how they help get you paid. But if you want to see the other powerful thing I do, covered calls on stocks I currently own, it's allowing me to generate up to 4% extra per year in income with the stocks. Click the video on your screen to watch our full options course. Thank you for your time.